Hey ballers, we are working relentlessly to bring you better information this year, and we need a little help with spreading the words. So please, if you have been enjoying our show last year, please write us a review and share us with a friend. This will help us to reach others who want to get into real estate or want to step up their real estate game. In this episode, we are still in January, so I want to prepare you or arm you with as many tools as possible so that you can have a wonderful 2022. So today I invited my friend and banker David Lindner to come on the show to talk to you about how you can go into the bank and confidently ask them to loan you money to buy your investment properties, even if it's a fixer-upper. If you are an investor, if you're in real estate and you have done a couple of deals and you're looking for different ways or different options or way to reduce your holding costs because, paying 10-12% to private lender or Harmony lender can eat up your profit. So what if you can do that and reduce that cost by maybe half? That would help, right? Because you can do less deal, more profit. So I highly recommend you to listen to this episode if you're looking for a different source of funding to buy more deals. But first, let's get to the intro. Hey ballers, welcome to episode 127. With me is David Lindner from Citibank. Hey David, thanks for coming on today. How are you?
Doing pretty good, B.
Can you give the audience a quick introduction?
Sure. My name is David Lindner. I'm a commercial real estate lender at Citibank here in Houston. I've been in the lending space for about probably 10 or 11 years or so. I'm originally from the Houston area. I guess moved back here in probably about 2010 or so. After school, I've been involved with community banks. And again, for the most part, lending on investment real estate here in Houston and around the state of Texas.
Okay. So before we go into some detail, can you maybe cover or define what investment the bank consider investment property to our audience?
Sure. I think we really sort of classify investment real estate as really just about any piece of real estate that you buy and plan on getting rent checks from. As far as stabilized assets go, that can encompass an office building, a retail center, a single-family home, an apartment building, again, sort of anything that creates a landlord situation for our borrowers. So we consider that investment real estate. Now, we also, in addition to people who are anticipating collecting rent checks from a property that they buy, we finance a number of people who buy, improve, construct, or otherwise build a piece of commercial real estate that they plan on selling at the end of the day. So a single-family home that somebody constructs, a spec home that they sell, an acquisition rehab of a single-family home, and to the same extent, an apartment complex or any other asset that somebody might buy or rehab and end up selling at the end of the day.
Well, let's bust this myth right now. The general myth or misconceptions is that banks don't loan money to fixer-upper. Is that true?
No, it is not true. No, I think that lending into the single-family space is not something that every bank does in the marketplace. For the most part, the bigger banks that you hear about or know about, the Chase and the Wells of the world, Bank of America, those banks do not lend into the single-family space for people to acquire and flip homes. That's just not what they do, and that's not what they're set up to do. But I finance, probably 8 to 10 people who buy homes to flip them and have done so for a number of years here at Citibank.
Okay, so let's talk about that. Because, generally when we're talking about single family investing, right? Buying a single family home as an investment home, whether to flip it or to hold it for rent and sell it at a later time. Generally, people are aware of borrowing money from private lender, borrowing money from family friends who also consider private lenders, or borrow from hard money lenders. But how can an investor position themselves, or what are the things they need to do so that they can go to the bank and say, hey, Mr. Banker, I'd like to borrow money to buy this fixer-upper property?
I think the two most important things for people who are looking to borrow money from a bank as opposed to a private lender or a hard money lender, first and foremost, you probably need to have a little bit of a track history behind you. For the most part, banks are really usually not in the business of loaning people their first dollar to flip something because they quite haven't figured out how to flip a home yet. So again, we have the cheapest money available. So again, we don't like to take that much risk. So, I think the biggest and most important thing is that whatever you're planning to do with the money that you borrow from the bank is that you have a little bit of a track history behind you, whether that's, that you own a couple rent homes, you've flipped a home with a hard money lender before, or you've otherwise been involved in the space, either for a single family home or whatever you might want to do, that you've, again, had some track history behind you because you are completely relying upon the borrower that we have to repay us and want to make sure that they know what they're doing and don't go $50,000 over budget on a rehab and then come to us because they don't have any more money and their contractor ran out on them because they paid him ahead of time and he took off somewhere else and didn't do the work. So like I said, having a track history and performance that you are able to demonstrate to us that what you are going to do with a single family flip, that you're capable of doing it, you've probably done it in the past. Again, that's the most important thing. Secondly, being able to have a clean financial picture to present to the bank is also very important. So if you have an entity that you've done some flips through before, but you don't really have clear and easy to read financials for the bank, it's very hard for us to determine or feel confident that we're going to get paid back. So like I said, having clean books is not an absolute necessity to borrow from a bank, but it certainly makes life a lot easier for us and for a prospective borrower if you've got an easy to read financial picture for us.
Is credit score important?
Only if it's terrible. The credit score is, I think we're required to run a credit check on everybody that we do business with. Primarily what we're looking for is somebody who's had bankruptcies, slow mortgage payments, anything that's indicative of somebody who's just not going to pay us back. If you have a medical collection for $100 and it drives down your credit score, you have a one late payment on a credit card that's only happened once and it makes your credit score a 700 instead of a 780, that's really not that big of a deal to us. Again, what we're primarily concerned with is your ability to execute on the project that you bring to us and your otherwise personal financial conditions. That's going to be based off your tax returns and financial statement more so than the credit score.
That's great. Because usually, when people hear about bank, right, they think they got to have really good credit score and a lot of money.
Yeah, I think the credit score is not really a top 5 factor for us when we're determining whether to loan somebody money. Again, the credit check is really to determine whether there's been bankruptcies or just, a long history of non-payment of bank debt.
So you're saying that, okay, here I am, V. Lee. I can walk into your bank today. I have done probably 3 deals, and I can walk into your bank and say, hey, David, I need to borrow money to buy this house, and I have maybe a 650 credit score and maybe some money in the bank. Those are kind of the general conditions that you're looking for?
Maybe higher than 650, V. Let's say 700. Yeah, again, for the most part, what we do is fairly easy. It's figuring out whether we're going to get paid back. And again, first and foremost in that is you being able to execute on your plan. So if you've had a track history of being able to flip homes and not go over budget and have those things work out for you, that's a big positive in your favor. Now, again, we also look for some other financial means. So if you wanted to come in and borrow money for your 4th flip home and you had just enough money in your bank account to put down the down payment for it, we're probably not going to be comfortable making that loan. And again, that goes back to anything can happen in real estate, which it does. You go over budget, the property doesn't sell when you think it's going to do, there's a downturn during the time that you're doing a flip. So again, what we look for is some additional financial capacity, whether that's that you have a day job or whether you're going to have leftover cash after you put down your down payment and do the rehab on the property. And again, that's really, we don't need to see enough cash for somebody to write a check to us and pay off the entire loan. What we're looking for is that person to have the financial capacity to come up with money if it's needed. If the project goes over budget, it doesn't sell on time, you have to carry costs with insurance and property taxes. Again, it's really to see the capacity from the borrower to be able to get through some bumps in the road with that project and anything else that they have going on.
Now, just to clarify something, do you guys loan to entity or is this the personal loan? Or is it depend on the case?
We can loan to either. If somebody's, buying real estate in their personal name, I would say it's probably far more common that people borrow through an LLC, which again is not a problem for us at all. Anytime that we loan money to an LLC, we get a personal guarantee from whoever the owner of that LLC is. So again, for the most part, look at the LLC, if there's a track history and years of activity in there, we want to make sure that the entity is good, but it still ultimately comes back down to the person behind the deal who owns the LLC. And again, their track history.
And so here's another, I wouldn't say it's a misconceptions, but the general public understanding is that when they go to the bank, it's cumbersome, right? They require a lot of paperwork and they take a long time to close versus going to a hard money lender that then can move at a faster speed or less cumbersome. What's your opinion on that? This episode is brought to you by Buzz Vacation Rentals, a premier property management company in Houston and Galveston areas. Buzz Vacation Rentals specializes in managing short-term rentals the right way. Give Buzz a call at 281-549-8432 to learn more, or check out their website at listwoodbuzz.com, and that is listwoodbuzz.com. Now, back to the Real Estate Ballers show.
I would probably say I've never borrowed money from a hard money lender before, but I would certainly say that dealing with the bank is probably slightly more cumbersome than dealing with the hard money lender, but I don't think that it's a night and day difference that you're going to be drowned in paperwork from what you need or what you need to get the bank in order to get the loan. It is probably we require a little bit more than the hard money lender is, but I think that the speed at which we can work is usually dependent on, again, the track history of the borrower and also the history with the bank. The people that I have some lines of credit outstanding to, that they go use those dollars either to buy rentals or buy homes to flip. We can typically close in 2 weeks or so. And again, that's based off the fact that that customer has a facility approved with us. They've been a longer term customer, so we've gotten familiar with them and we have a comfort level there. Again, going back to what makes us more likely to loan more money to somebody is you having borrowed from the bank on a couple of different occasions and done everything that you said, paid on time, had the project work out, pay us off and come back for more money. Again, that's a very big component to it.
Yes, I think it's very important to pay back, right? Because I know there were deals I was involved in and my lender, the bank, made more money than I did. And I was happy to do that. So I think that one of the difference between the community banks versus if you go to the big banks, you guys have your own underwriting. You have your approval process is completely different than the approval process of Wells Fargo or Chase or Bank of America. Can you maybe share some of that with us?
Sure. I don't know whether it's the misconception comes from the fact that a lot of the times, people that go either buy a home to live in or if they're, trying to get a conventional loan for holding a rental, that is a very, very burdensome process. I do it for the rentals that I have, and it's a huge pain, but I'm a banker, so I'm used to it. But the community bank process is, again, as opposed to whatever you might want to go borrow money from Wells Fargo for, again, our documentation requirements are typically a little bit less than them. Again, we still have a certain amount of ability to use common sense and understanding whether a loan is going to get paid back or not, or whether I have a good borrower in front of me. It's not just sent off to, underwriting in Ohio somewhere that somebody who doesn't know you and doesn't understand your business is deciding whether or not Wells Fargo should loan money to you. At the community bank level, depending on the dollar amount, there's really usually only ever about 2 or 3 people involved in the decision-making process. There's myself, who, again, I've spent enough time in banking that I can usually determine on the front end whether the bank is going to be able to loan money to a person or not. I mean, that really only takes me about a day or two. And again, once I make that determination, we send it to underwriting, which, we have a group here. And then again, at a certain dollar amount, really, there's only one other person signing off on that loan request, and he sits down the hall for me. So it's a bunch easier just because there's less people involved. And again, as opposed to a bigger bank, we still have a certain amount of common sense that we get to use in determining whether we can make a loan to somebody or not.
How important is the depository relationship?
It certainly helps out. In the community bank setting, we're very big on relationships. I don't want somebody to come borrow from me one time and then go and borrow from somebody else and somebody else and somebody else. It's usually not worth our time if that's the way the relationship works. So again, establishing a depository relationship certainly helps in the fact that we understand that the borrower is looking to establish a long-term relationship so they can move the deposits over and want to utilize, everything that we have to offer here. And it makes our time and effort worthwhile because we think we're going to get a long-term relationship out of it. And it just helps the whole picture in terms of us making a decision on whether we can bend the rules a little bit or, extend credit a little over what somebody otherwise might. If we, have the deposits and have a full relationship with somebody.
So as far as depository relationships go, what is a meaningful relationship in that sense? Are we talking about double digit, triple digits?
No, I think it's relative to how much money somebody wants to borrow. If somebody wants to borrow $20 million and has $1,000 on deposit, that probably doesn't quite add up. Typically, sort of our quick answer is, usually if somebody wants to borrow a certain amount of money, whether that's $1 million or $2 million, if the depository relationship is usually somewhere at least between 10 and 15% of the amount that they want to borrow, that's usually a good starting point. Again, if there's more deposits than that, that's great. It strengthens, it makes it easier for us to loan money. But it's normally in that about 10 to 15% range of the total dollars that you want to borrow.
And is it normal for the bank to require the client, the borrower, to pledge the funds?
No, those funds are really not restricted in any way other than you having your operating account and extra cash here. The only money that is required by the bank is the portion of the project cost that is your equity going into it. So again, there's no restriction on those deposits. And, I know with real estate people, that dollar amount tends to fluctuate as you get involved and get payoffs and make money on projects, that it sort of goes up and down. So it's not a expectation that it stays exactly at 10% and never can move and you can't go under that. Again, it's going to be your operating account. That's what you use to pay all your bills through your business. So no, there's no absolute requirement. If you come bring it over and we approve your loan and you take it all the way, that's probably not going to look too good for me. But no, there's not.
We might not be able to get another loan, huh?
Yeah, no, I hope you enjoyed the first one.
Yeah, that was going to be what I was going to ask next is, what if someone just go and say, here, I'm putting up $75,000, and then they get a loan and they take that same money and go to another bank and try to do the same thing?
Well, sooner or later, I assume they run out of banks to go to once they pull their money back out of the old ones. So no, it's not the end of the world for us that somebody borrows from another bank. That's not really a huge issue. It's probably beneficial to borrowers to have more than one bank that they can potentially go to, just in case, for whatever reason, banks' lending appetites change sometimes. You reach a certain dollar amount before, you get a longer track history with the bank. We might feel comfortable starting it at $1 million, and then, maybe that dollar amount goes up in the long run after we get some history. So again, it's not the end of the world, and it's not a huge issue that somebody's borrows from another bank. But as long as it's sort of open and you're not trying to game the system, which is pretty easily looked through on our part, it's not really that big of a deal that one of our borrowers has a relationship with another bank.
Can you walk us through a typical deal on an investment? Let's just zoom in on the single family home. Mm-hmm. Let's say I have a deal, you agree to do it, and it's going to need some rehab it has a rehab budget. Can you walk us through that process of how it works when we borrow money from the bank?
Sure. I mean, I'll sort of skip past the underwriting part and assume that you're already approved. Yeah, so I mean, if somebody has, again, an open facility or already has their approval taken care of with the bank, when they find a property to go buy, really all that we need from them is a copy of the contract and then a copy of their rehab budget. And what I do with that, we, depending on the dollar amount, are able to utilize an in-house valuation rather than getting a third-party appraisal. So I take that contract and the rehab budget and send it to our internal real estate group. You know, they value the property and come up with their after repair value. And that's really it on our part. We also get the title company contact from whoever you or the seller choose to use for the closing. And again, from that standpoint, once I get back the evaluation, which typically takes us about a week or so, and once we get back a clear title commitment from the title company, we're able to order loan documents. We do that internally. That usually has about a day or two turnaround. And then we send everything to the title company so they can square away the closing. And that's really just about it on our process. Again, once we've sort of got past the approval, the actual project-specific work is pretty limited and usually a pretty quick turnaround.
You guys the loan amount is typically based on the evaluation value. Is that correct?
It's confirmed by the evaluation value for flip properties. I mean, our standard is anywhere between financing 80 to 75% of the total project cost. So that includes your purchase price plus any rehab. So if you had a house you were buying for $100 and needed $50,000 of rehab, we would loan you 75 or 80% of that total of $150,000.
That's good to know. Okay, so that means the borrower will need to come in with the difference, ultimately
Correct.
require them to have some funds.
Correct. So, I mean, typically of the total project cost of the $150,000, if we were making an 80% loan, they would need to bring $30,000 to the closing of the property. And then we would have the remainder of the loan fund of $70,000 of the $50,000 for the rehab. That would be available for the customer to draw on the remainder of the loan. So we would advance those to you to be used for the rehab as you need it. So at the end of the day, you know, we would make that fully advanced loan. And again, would be, you know, interest only for 12 months is our typical acquisition rehab loan for single family homes. So again, we would make that for 12 months, and then hopefully during that time, you would complete the rehab and either find a seller or put a renter in it and then refinance long-term for the rental property.
So did you mention that you have a holdback on the rehab and then you release it as the work is being completed?
Yeah, I mean, we'll fund that rehab budget into an account, and then as the rehab gets done, we'll send an inspector. That's just usually somebody here locally who's also a home flipper that ends up going to look at them. So that's usually about a day or two turnaround to get those funds released to pay the framer, electrician, plumber, whoever you had out to come do the work.
What does your typical project look like? Your single family home deal, what do they typically look like?
I think from everything that I've started to get throughout this year, prices have increased a little bit, but I would say our average flip that a customer does is usually anywhere between, in terms of the total project cost, anywhere between $150,000 to $300,000. It probably captures about 90% of the flips that I have people bring in. I mean, we don't end up doing a lot of high dollar amount flips. I think that's mainly because my customers are smart and they know those are risky. So again, for the most part, I think that probably encompasses about 90% of the flips that I see that are in that, in that affordability price range for the sales price.
What kind of deals would you guys walk away from?
I think that we would walk away from deals that on the single family rehab space, if somebody was planning to do a very, very, very extensive rehab and didn't have the history of doing very, very extensive rehab, I would not believe that they're going to come in on budget. So again, for the most part, most of our rehabs that I see from our customers are anywhere between $15,000 and $50,000 is probably about the average rehab. Again, probably grabs 90% of the rehabs that we do fall into that space. Another one I would probably decline or probably either change the terms or be cautious about getting into a $750,000 and above rehabs. I mean, those are just very tricky projects that, again, unless you absolutely know that market, I think you can get burned pretty quickly on the expensive flips.
Well, I consider myself experienced, and I don't like extensive rehabs either. They're very consuming, so you should know what you're doing before you enter those kind of extensive rehab. So I think one of the things that you mentioned earlier is that the relationship is huge when you're working with community banks. So how does one person go about finding bankers that can help them with getting these loans done?
I would say it's probably a difficult process unless you know somebody. Probably over half the customers that I have that are in the single family space have been referred to me by somebody who's an existing customer. And again, like we talked about earlier, not every single bank wants to do single family properties. I met with a group earlier this year that had been borrowing hard money for a number of years. They flip 80 homes a year and, had talked to a number of other banks. And as soon as we sat down to start talking and they were referred to me by another single family home flipper, our conversation just went so well. And they immediately understood that, well, hey, this is the banker that actually knows what I'm doing and he's going to be able to help us out. So again, in order to find a banker to help you with specifically in the single family space, I think your best bet is probably to try to talk to somebody else who's already in the single family space who might have already used a community banker before, because if not, I think you're probably going to walk around to 10 different banks getting no's before you finally find a yes. So like I said, I think the best way to find a banker to help out with the single family space is to talk to other people who might have already used one before.
I agree with you, because if you just blindly walk into any community bank, you probably end up wasting your time. Because I would agree that a lot of bankers don't know what they're talking about or don't understand the nature of our business.
Yeah, I think that's true. And, even at a community bank, just because inside of a community bank, more so than at big banks, we're able to pretty much do just about every single kind of loan that you can think of. Even if you walk into a community bank and talk to a banker, that guy might not know anything about single family because all he does is, industrial. So he doesn't really even know. So he might not be the best person to talk to about, even though that bank and a banker at a different location might be the expert in single family home flipping. Depending on who you talk to, again, you might still get a no, even if the office down the street would have been a yes.
So it looks like the best advice for finding a banker that understands the nature of our business is maybe just go around and ask other successful flipper investors who they use and maybe build that relationship there.
Yeah, I think that's true. I think most successful home flippers have, for the most part that I've met, most of them have made their way to borrowing from a bank at some point. The people who are flipping at high volumes, again, usually have a track record and history that would allow them to borrow from a bank. And again, the bank financing is really just about the cheapest you can get out there. So most of them know that and usually
I can attest to that.
Yeah, I know.
Well, I'll tell you this, though. When you borrow money from the bank and your holding cost, your holding cost is actually reduced by half almost, right? Compared to hard money lender. And sometimes, it afforded me the ability to slack a little bit. But it's a bad word, but I don't have to put a lot of pressure on us, on the contractor, on the team to try to move the property quickly because we having to pay so much interest to, a hard money lender versus a bank.
Yeah, I think true. The fees that we charge are typically less than a hard money lender, and obviously the interest rate is less. And again, with our home flip product that I'll say, it's just a 12-month interest only, usually provides you a little bit more time where, I think a lot of hard money lenders have a 6-month trigger. If you're not done at that point, it usually involves you paying another extension fee to get more time with them. So again, the most difficult part of dealing with the bank is the initial underwriting to try to get the loan in the first place. But typically after that's done, it's a relatively easy process that doesn't really apply too much pressure unless you've screwed something up by the bank.
Yeah, so don't be afraid of the bank. I think you should open yourself up, for investors, the audience who are listening. You should give yourself that option to have the ability to borrow money from the bank for the right property. You probably can't borrow money from the bank for all properties, but you should be able to borrow for some properties.
Yeah, I mean, I think that if you find the right banker who understands what you do and what you're doing, I mean, it's usually a fairly straightforward and easy process. Now, like you said, I mean, I've turned down plenty of people who wanted to borrow for single family for one reason or another, whether it was the project or whether it was a lack of a track history. But again, I mean, once you find somebody who knows what they're doing, who has a track history, I think the approval process is fairly straightforward and pretty easy. And again, once you get in the bank and you sort of prove yourself a couple times over with some projects that you do, it's again, you sort of earn some trust from the bank, and the relationship's usually pretty easy.
Well, one of the things, I'm changing to a different topic here, and one of the things that make you, David, unique is that you also own several investment properties.
That's true. I've not flipped any properties, but I'm a buy and hold single family investor owner. So it certainly helps out understanding the reasonableness of people's plans, either for flipping properties or owning properties long term. It certainly helps out and lets me sort of get in the shoes of my borrowers and investors. Every now and again, provide my 2 cents of advice to people when they have a plan to either buy a property, flip a property, or again, typically sort of anything that they're getting into that, that's involved with single family real estate, whether that's long-term management for buy and hold rentals, whether that's trying to find a contractor to do the work for you on the front end of a flip or find subcontractors, or just generally, how they want to set up their finances, either holding rentals long-term or overall how they want to finance their flip activities.
I've talked to several investors, and they actually talk about like this package, a bank presentation package, when they go to a new bank and trying to create a relationship. Do you think that's necessary?
I would say that maybe it potentially is. With me, it's not. And I just say that because I'm familiar with the single family product. If you're going to talk to somebody who's not completely familiar with the single family space, you're probably going to need to or want to provide them more information if they're not already up to speed on what goes on in that space. With me, I can just look at somebody's track history and, they can sort of point to the projects that they've done. And again, it's sort of right sizing their financial capacity to how much we can potentially lend them. So again, I would say it's not a bad idea, but again, I think if you find a banker that knows the space that you're operating in, I don't think preparing a 10-page business summary is completely necessary.
Well, thank you. All right. So, what are some other advice that you have for any investors who's looking to work with the bank that we haven't covered yet?
I think the biggest advice that I think that I have for people borrowing money, period, whether that's from a hard money lender, private lender, friends and family, or a bank, the financing does not change your deal. It really does not. I mean, the single family home that you buy to rent long term or the single family home that you acquire to go flip, the financing is not going to change the outcome of that deal. You either bought a good deal or did not buy a good deal. Again, the financing is just not going to change that. So it's great to be able to borrow cheaper money from a bank. And as opposed to a hard money lender, we have a little bit higher equity requirement that you have to be into the deal. So a lot of people don't like to hear that from the bank because that ties up more of their money or limits the number of deals that they can do. But the financing is cheaper here. And in the long run, you end up making more on the project if you borrow from a cheaper equity source. But again, just finding a cheap equity source is not really the biggest issue that I have. I think people should spend the most amount of time trying to go find a good project because that's what's going to make you profitable and give you a good track history. And again, get in a better financial position to be able to go put down 20 or 25% with the bank because you have enough money off the good projects that you've done. I mean, I think that's the biggest component rather than just spending all your time and effort trying to find the cheapest source of financing. You should spend all that time and effort trying to find the best deals.
Yeah, like I say to my team all the time, cheapest is actually not the best. It's, the best, whatever, make the best use of your time. Being frugal is different than being cheap. So,
Yeah, I think that's true. And again, I have customers that are in the single family space that I have, some facilities that they use to flip homes. And they still use a hard money lender every now and again because that's the best solution that works for that particular project. Again, getting a bank loan is not always the best thing in the world. Sometimes we don't want to do the deal, so you still need somebody else involved that will finance the project for you and let you make the money because it's a great project, but it just doesn't fit for the bank.
Right. Okay, so what is the one thing that people might be surprised to learn about you?
I have no idea what they'd be surprised to learn about me. I'm pretty boring and average. I guess that
something your boss you don't want your boss to know?
I'm a fairly squeaky clean employee here, B. I am almost 39 years old and I have an 18-month-old. So I'm a very, very old father with all my gray hair, with more coming each day.
Well, David, if you're watching, David might look more mature than he is. But he's a banker. All right, so how does the audience get in touch with you, David?
Sure. The easiest way to get a hold of me is either sending me an email or calling me. My phone number is 713-292-3312.
All right, well, David, that's a wrap. Thank you for being here.
Okay, thank you so much for having me on, B.
Thanks for watching the Real Estate Ballers Show. If you find value in this show, give us a like, subscribe to us. Please help us spread the word by sharing this episode with a friend, or give us a shout out on social media using the hashtag REBallers. Lastly, leave us a comment below. Let us know how your real estate investing journey is going. If you learned anything from this episode, or if there's something that you want us to cover, let us know. Leave a comment below. See you next time.